So recall that in the last episode, one of the ways I mentioned we can allocate capital in a business is to deploy it for a business acquisition. And while a lot goes into the analysis and due diligence of whether to purchase another company, we'll spend the rest of this series analyzing it purely from the perspective of financial theory and valuation mechanics. Fundamentally, the question we're trying to answer is simple. Does the intrinsic value of this acquisition, given our cost of capital and the risk involved, exceed the price we have to pay for the company? So let's spend the rest of this episode quickly walking through the potential acquisition we'll be analyzing. We're looking to buy a company called Evergreen Lawn Services, a fairly decent-sized commercial and residential lawn care and landscaping company. We'll assume we're approaching this as a share purchase, as opposed to an asset purchase, meaning we'll purchase the shares from the existing owners and the current business entity will continue to operate as is. And we'll also assume we'd be purchasing 100% of the shares outstanding. So I've pulled up here the financials for the prior 3 years provided to us by Evergreen as part of the exploration process. Let's start with the P&L, which is relatively simple. You can see here they're earning revenue of between $2.5 and $3 million, and it's been growing nicely over the prior 2 years. Then their cost of services consists primarily of salaries for their employees, some removal and disposal costs, safety costs, along with fuel for their equipment. All leading to a gross profit between $1.6 and $1.8 million, which has been steadily growing as well. Then their operating expenses are pretty straightforward, nothing really of note here. Just basic items like administrative payroll, office supplies. They seem to do quite a bit of advertising, carry insurance, etc. And then finally we have depreciation of their PP&E along with interest expense. So I'm guessing we'll see some debt or a lease or something on the balance sheet. Then finally, one thing I want to note is they haven't recorded any income tax expense at the entity level. So presumably this is some sort of pass-through business structure, like an LLC or an S-Corp. But income tax is something we'll need to keep in mind as we build out our acquisition model. And as you can see, all of this led to annual net income of around $564,000 in 2023. Which has also grown steadily over the last 2 years. So we have a solid business here, generating a steady and growing operating profit, and you can certainly see why we're interested in acquiring it if we can agree on a price. If we now turn over to the balance sheet, this is relatively simple as well. You can see they have a healthy cash balance, some basic current assets like accounts receivable and prepaid expenses, then some fixed assets we might expect to see in a company like this. They own a building that they purchased for $100,000, have some computer hardware, furniture and fixtures for offices, and finally, a majority of their fixed assets are machinery and equipment, presumably lawnmowers, trailers, tractors, and maybe they classify work pickup trucks here as well. Then for their liabilities, fairly simple, we have some basic working capital items like accounts payable, payroll-related accruals, and deferred revenue. Then finally, they have a small amount of debt. Let's assume this is a revolving credit line with a bank, and we'll want to remember that because that will impact the equity value of this company down the line. Then finally, we have their shareholders' equity. You can see they've invested $240,000 in the company through equity, and then retained earnings which have been reduced for some dividends paid out to the shareholders each year. Clearly, you can see the retained earning balance at the end of 2024 of $144,361 doesn't equal the retained earnings plus the net income from the year prior. And this is because they've chosen not to retain all their earnings in the business by returning some capital to shareholders each year in the form of dividends. So that's it. That's the company we're looking to acquire. Now, to lay the foundation for the work we need to do, let's wrap up this episode with the very high-level steps we'll have to go through to perform our analysis. First, we'll need to model out the future free cash flow we feel this company can generate. And to do so, we'll lean heavily on the results of the last 3 years. Now, in reality, this would include a lot more due diligence. You'd want to analyze the market, do some work on whether their rate of growth is sustainable, analyze their customers and any risks there, and so on. But we're focused purely on the time value of money and discounted cash flow mechanics in this series. So we'll try to keep all of that pretty simple as we model out the free cash flow we feel this company can generate. So we'll model out and forecast the free cash flow from the operating business for the next 5 years, which is a pretty typical timeline for a discounted cash flow analysis. There are certainly reasons to use a different timeline, and we'll talk briefly about those, but 5 years is fairly standard. Then second, we'll need to determine our discount rate, and this will relate back to the discussions on interest rates we've had in the past. But in the context of a business acquisition, we'll need to think about our plans for the ongoing capital structure of the target company. And we'll end up determining a weighted average cost of capital, or WACC for short. And that will require an episode or maybe even 2 as we dive into the cost of debt and the cost of equity. Then third, we'll need to determine a terminal value of the business at the end of that 5 years. There are a couple ways to go about this, and it partially depends on our plans for the business, whether we think we'll hold this in perpetuity, or maybe we're planning to purchase and then sell it after 5 years' time. So we'll go through that analysis as we build our model. Then fourth, we'll use all of this information to determine an enterprise value for the operations of the target company, and use that to further inform us as to what a fair purchase price is for the equity of Evergreen. And finally, we'll do some basic analysis on our potential returns and discuss the impact of how we finance the acquisition to wrap things up. So those are the steps we need to begin checking off. In the next episode, let's begin to model out the free cash flows of this company.